Welcome to Vantage Point Podcast, a podcast brought to you by NWR Communications and 92 Studio. This podcast is intended for education and entertainment purposes only and does not constitute financial advice. In this episode, we're joined by Phil Hodgson, Calix's CEO. Calix is listed on the ASX under the ticker CXL. The journey of Calix is a fascinating one, which we've worked with Calix since it completed its pre-IPO in 2018. In this episode, recorded at the end of last year, we hear about the platform technology that has Calix positioned to make a meaningful difference to decarbonising the world in lime and cement industries, green steel and material processing with a lithium joint venture with ASX-listed Pilbara Minerals. Phil is a straight-up guy and one of the good guys in the industry. Subsequent to the recording of this podcast, there was some unexpected news with a site change as a part of the scale-up of Lilac 2. It's fair to say the stock was hammered, but with an announcement from Heidelberg Cement reaffirming its commitment released just yesterday, it's game on and all set for a big 2024. We hope you enjoy. G'day and welcome back to our latest episode of Vantage Point, where we get behind the leading minds of mostly listed companies. And I think we're really privileged today to have with us Phil Hodgson, the company's CEO. Calix has been around for a long, long time. It's a company that I've worked with for more than 6 years. It's been a pleasurable experience where we talk about on this podcast actually getting behind the people and what runs the business. The people behind Calix are the most genuine that I've come across in terms of if they can't do something, they're not going to tell you that they're going to do it, which a lot of CEOs fall into the trap of in terms of over expectations. But it's a company that's pioneering sustainability solutions across a number of industries, which in some eyes people are talking about it. But it's one of Australia's hidden secrets. Hopefully not hidden for too much longer. But it's a fascinating story in terms of founded in 2007. The company did a pre-IPO round 6 years ago, where Thorney Investment Group, one of the investors, they're still a substantial shareholder today, Alex Weislett's group, which says a lot about Thorney, but probably more so about Calix in terms of, again, that under-promising and over-delivering. The company listed just over 5 years ago, raised $8 million at 53 cents. It's always been very meticulous around its use of funds in terms of capital raisings. It's a cash-burning business, if you take away the water business, which we'll go into. But raised $17 million at $2 in 2021, I think it was. And then in 2023, or so just over a year ago, November 2022, raised just over $80 million, just over $4 a share. So there's that careful capital structure consideration, which you can see across the journey. And I think what they've delivered today is testament to that as well. So Phil, thanks so much for joining us today and looking forward to the chat. So before we sort of get to the business itself, I think a story that many haven't heard before, and it's one that I heard a long, long time ago, and I always thought if the company was successful, it'd make a pretty good book or a pretty good movie. But just talk to us maybe first around the founders of the business and just sort of the origins around the founding story.
Yeah, sure, Simon. It's one of those great Aussie sort of technology startup stories. It's a combination of a chap who was a mining engineer, a bit of a knockabout guy who had the original concept of a new type of kiln or furnace, a new way to heat stuff up, and combined with the sort of background of a scientist in Mark Skeets. And so Connor Hawley and Mark joined and founded the company in 2006, I think, off the back of this idea about a new type of kiln or furnace. And so they started out with very little capital. They built the original kiln or furnace to test it, and
is that in Bacchus Marsh?
It's lying in Bacchus Marsh now, but it was actually originally built in Jacob's Well and erected in Jacob's Well. It was a little tower with little gas burners, and you used to have to run up a series of stairs and pour material down in buckets down this thing to test how it heated up as the material sort of fell through this tube. And that was enough to sort of prove the very basic concept. And off the back of that, they were able to raise some early capital from Washington H. Solpats and start to build bigger and bigger versions. And so from a backyard bucket experiment, ultimately the company was born. And we can sort of go into the various periods of history as we go through. There's many chapters, as you know, Simon. But
I think the chapter that we're most interested in is just around, I'm not sure the exact year, but basically the company was dead.
Yes, look, I think many companies go through a valley of death, as they call it. I think we've been trekking through the Himalayas because we've been through many valleys, but we're finally climbing Everest. We're out of the last valley. But the biggest valley of death that I experienced was soon after I joined, and in fact, around 2 days after I joined the company, I had a call from our CFO, Darren Charles, who's still with us. And Darren said, Phil, I think we've got a bit of a problem. I found out that there's been an overspend on the project that hasn't been reported. And this is the project building our first commercial scale version. And the project's $2 million overspent and we've got $2 million in the bank. And so we were close to being technically insolvent that first year as the CEO. In fact, 2 days into my job as CEO.
Baptism of fire.
So we had 57 board meetings in the space of a year. We nearly tipped the company into administration 3 times. And ultimately, how we got through that first year was a lot of sacrifice by staff and management. I sold my house, and
so when you say you sold your house to put money into the company and keep it alive.
Yeah. So put money in the company, salary sacrificed. Yeah. So I dropped to 40% of my sign-on salary, and all of the execs did similar. So, but it was everyone just
Mark,
put.
Mark, one of the founders, he also mortgaged his house to prop it up.
So everyone put in real hard, and as I say, it was touch and go, and it was not an easy situation because the company had a whole lot of debt at the time as well. It had a convertible note, which was a convenient way to raise capital at the time, but that convertible note was particularly nasty. And so, in fact, if I look back upon my whole career, even since that time, the deal I'm most proud of is converting that convertible note to equity and persuading the note holders to do that. And we could only do that by taking the company to the brink of collapse.
That was like literally the last hours.
It was like a second to midnight in the classic sort of, and we had to stare them down, and they backed down and agreed to convert to equity, and then new equity, including from us, came into the company at that time.
Because all the staff at that time as well invested.
Correct. Yeah. Every single staff member, and sure, there was some who was able to put more than others, but it was incredible. And so you have everyone of a very small core team there who invested in the company and its future. And at that time, I think we raised $3 million, and I think the post-money valuation was $10 million at that time. So that's 2014.
But again, when you look to now, what's that? Almost 10 years ago, there was nothing really built.
No. I think we'd just completed the first sort of full-scale calciner for magnesite. We'd done some tests on it, and it looked as if it was working well, but we had established 0 markets really in terms of any sort of revenue, and even the business model was unclear at that point in time because we were initially looking at making a magnesium-based building product, and we sort of had this side hustle called a magnesium-based water business. And so the company really needed to set a strategic path a little different to that. And of course, the decarbonisation at that point in time was it basically didn't exist. I mean, a lot of decarbonisation was talked about, but in terms of actual doing and in actually investing in decarbonisation technologies, it was like a desert. And so it was a big leap of faith by all of our staff members and the management and our directors. All the board members put in too. Big leap of faith in the future of the company, and especially around its decarbonisation ultimate strategy, which, as we'll cover off, no doubt, took a while to come to fruition, but certainly has now.
So it's $3 million on $10 million valuation, all the way to $1 billion plus at its peak. It's quite a journey. If we can just sort of step back and go through the different lines of business and really the sort of core technology platform and sort of how that evolved from the magnesite, doing the water and whatnot.
Yeah.
Hey, this thing could help lime and cement.
Yeah, so I mean, as I mentioned before, it's just a new type of kiln or furnace, a new way to heat stuff up, if you like. And I usually have a little toilet roll. I should have my prop with me today, Simon. I can bring one out, but
I'll go to the toilet and get you one.
Go to the toilet and grab me one. It's a great prop because you can flat pack it into your pack and bring it out, and very flashy. But basically, I demonstrate this with a toilet roll, and all the toilet roll represents is a tube. It's a rather large steel tube. The biggest ones were built are 1.8 metres in diameter and over 30 metres high. And we heat this tube from the outside. We can heat it with whatever energy you like. There can be flames, there can be electrical elements, and so we're energy agnostic. And that's a big difference in the kiln world. Most kilns are designed specifically for certain energy sources. We're energy agnostic, which is great because as the industry electrifies and evolves, we can just our core technologies moves with it. The second thing is whatever we heat goes down the middle. It just needs to be a small particle size, and that's basically just drop down the tube. Imagine dropping a lump of flour to the floor and watching it float down. That's all that's happening inside our tube. These particles are just falling slowly over 20 to 30 seconds, and we've heated the walls of the tube to over 1,000 degrees centigrade, so they're glowing red hot, and that radiative heat into the particles is what does the heating. So, as I say, just a new way to heat stuff up, but why do it that way? So, let's have a look at cement and lime as one of the first lines of business. Cement is made from limestone, and limestone is nearly half by weight CO2. And so when the cement and lime industries heat that up, it releases the CO2 out of the rock. And they're responsible for over 8% of global CO2, and over half of that is coming from the rock. So no matter how much they electrify their process down the track, they're still got to deal with half those emissions. Now, with our kiln, you can imagine that tube, as the limestone particles are falling through, it's releasing that CO2. That CO2 is not mixed or lost to the atmosphere. It's not mixed. So it just basically comes out the top of the tube as a pretty pure stream. And out the bottom comes the normal product. And so what the kiln represents, you can renewably power it, of course, but it also directly separates the CO2 that's coming from the limestone. And so it's a way to mitigate and drop the CO2 intensity of cement and lime substantially and ultimately eliminate it. And so for the cement and lime industries, which are one of those really tough industries to deal with the CO2, the kiln just represents a different way to heat up that mitigates the CO2. Simple as that. And you mentioned some of the other lines of business we're looking at. I mean, what's exciting here is heating stuff up is actually what happens in most mineral processing applications. At some stage, you've got to heat it up. And all of that is right for electrification. And let's take iron and steel making, for example. Australia, nearly half our total income comes from exporting iron ore. And that iron ore actually is unsuitable for an electric arc furnace. Now, a lot of people talk about the green steel heading down the electric arc furnace route. Now, that's a big existential threat to Australia as a country. So what can we do? Well, if we actually make a green iron here and export the green iron into steel making, then that could be a way to value add here and keep us relevant in the international market. And so we go back to my toilet roll, we go back to our tube. If we fill that tube with hydrogen, and we don't lose that hydrogen to the furnace or the atmosphere, it's just contained in the tube. We heat that tube and put iron ore in the top, we can convert that to iron. What the hydrogen does is it sucks the oxygen off the iron ore. Iron ore is basically rust. That's why it looks brown. So it sucks the oxygen off the iron ore and makes water. And the water and the hydrogen mixture, any unused hydrogen comes out the top, and out the bottom comes green iron. So as long as you use renewable electrons to make your hydrogen and you use renewable electrons to heat our tube, you can make a green iron. And so it's a way to use the abundant renewable energy resources we have in this country combined with an existing major export to add value onshore and make a green iron.
That's sustainable,
So they're just two sort of examples of the applications of the one core technology. Obviously we're doing a project with Pilbara Minerals for processing spodumene at the mine site to produce a lithium salt. Spodumene is the source of over half the world's lithium today. So if we can use the mine site to actually extract the lithium on-site using renewable power. We can leave the 94% waste that's currently exported as spodumene. We can have that at the mine site to help rehabilitate the mine.
Basically like the equivalent of onshoring.
Onshoring.
Similar with iron ore as well.
Absolutely, absolutely. And so just with those examples, I guess, Simon, you can start to see the sort of different possibilities you have with the one core technology. You know, as we said before, homegrown Aussie technology, but, you know, very serious applications. Absolutely.
And just diving into the green steel, which, you know, Zesty, how does that fit into, you know, the iron ore process or production sort of circuit? Is it a huge disruption for them to have to, you know, reconfigure all their sort of different things, or how does that sort of look?
Yeah, so at the moment, when you mine iron ore, as with any mining operation, you're basically pulling the ore out of the ground and you're crushing it down to make it big rocks into usable lumps that you send offshore. And in doing that, as you crush stuff down, you create dust or fines. And at the moment, a lot of that is dust or fines are either waste or very low value. And this is not just iron ore. This is spodumene. This is a lot of other industries as well. So what's perfect for our kiln are those small particles. We love small particles. And so what's currently waste or low value is actually right in our sweet spot in terms of processing to a useful product. And so with an iron ore extraction process that's happening today in Australia, it'd just be an add-on that uses their waste material to make a green iron. So in fact, it's not disruptive or anything to their process. It's a neat add-on that would use up some of their waste.
Yes, it's not going to cause an almighty sort of circuit breaker that then they have to reconfigure mine sites and all these sort of different things. It's reasonably straightforward.
Yep.
And just in terms of the funding, so, you know, we talk about, you know, mineral processing with Pilbara, lime and cement, lilac, green steel, Zesty, you know, and then there's the biotech, you know, marine coating. There's a whole bunch of different sectors which, you know, early on the market sort of said that, you know, we were crazy, you know, just nail one. But I think we've sort of demonstrated that, you know, we actually, particularly, broadening the team and focus, and you're actually executing. You know, there was no Pilbara, materials processing, 2-3 years ago, sort of thing. It was a pipe dream. But now it's a fully commercialised or fully formed joint venture, which is a serious validation point. But how do you sort of look at, if you can just sort of talk us through the the revenue model, but B, are you building these things? Is it going to cost a whole heap of money in terms of capex for Calix and its balance sheet? How does that sort of look? Yeah,
it's a really good question, and it's something that we spent quite some time thinking really heavily about. Where does a technology that is applicable across multiple different areas get applied as quickly as possible, and how does it get applied as quickly as possible? And the other thing is, what I love about, say, the software industry is you design and build something once and then you get multiple revenues coming in from that. And so a licensing or royalty model was always attractive to us. And so as a tech company, that's nirvana. That's where you want to take your business model.
And you can fully scale as well.
You fully scale it and all those sorts of things. So build it once, have multiple parties pay you. That's the license royalty model. We had a lot of pushback on that. Not only from people who were asking to be part of that, as in pay us a royalty or license, but also from the industry in general, because those sorts of models we've never seen it. For example, in the cement and lime industry, we've never seen a technology model that was operated on a royalty or license. So the traditional big engineering houses like the ThyssenKrupps, they ultimately were forced by the cement industry into what we call the OEM model, which is they're building the bits of kit and then selling it to the cement plant. And they're always at loggerheads over how much margin ThyssenKrupp can make for that piece of kit, for example.
It's a race to the bottom.
It's a race to the bottom, absolutely. And so we never wanted to play in that space. And we felt we had the technical strength and the technical moat, if you like, to not play in that space. And interesting thing was, despite the fact that was our model for a while, we were only able to really nail it and prove it when we signed that license agreement with Heidelberg Materials. Global perpetual license. They've got to pay us a license fee per tonne of CO2 separated. That took, the initial discussions with that type of license model started in 2015. Okay, so and in earnest for at least 3 years. So it took us a while to punch that through, and we got it. And since then, in pretty quick succession, we got the next one through, which is the application of the technology in direct air capture, but it's a lime-based application of the technology. So there's 2 global perpetual licenses in place now. So we like to think of our business model as validated. Now, what does that allow us to do? As soon as we get a license type arrangement, we don't care who builds the plants. And so in terms of capital required to deploy the tech, and when I think about that, and I think that to solve the issue in cement and lime, a full-scale version of this plant has to be built twice a week from now to 2050, okay? That's how much deployment has to take place to hit the CO2 targets for the cement industry that they've set for themselves. Imagine if we had to have that on our balance sheet to go and build. It'd be exactly right. And so in putting this licensed business model in place, it's the cement companies who and to be honest, that's where it should be. Those guys have big procurement muscle, and all they're building are structures, towers with our tube in it and the peripherals. It's nothing like some super high-tech stuff. We can give the cement company a blueprint. They take the blueprint, use their procurement muscle to drive down the cost of the capital and deployment.
And particularly if they need to deploy so many of them, they're going to get a decent price on
Exactly right. And what that allows, that's great for us because ultimately that drives down the cost of our technology at the same time because it's really all tied up in the capital. And so we knew that business model was ultimately going to be the best way forward for us. And so that's the way we've cemented that business model now in Lilac and rolling that out. Pardon the pun. And rolling that out. And look, in other large commodity industries where wide scale and rapid deployment is required to decarbonise, it's a very similar business model that we're looking at for, say, iron and steel, for example. No,
that makes perfect sense. And without trying to get too deep into the science or specifics, but if you could just sort of take us on the journey around the lime and cement producers about, almost like the carrot and the stick, the penalties and the concessions around carbon credits and these sort of things. And what it sort of looks like, what it looks like in terms of the carbon credit price, it sort of can only go one way, really. And then on the flip side, obviously we've got a royalty on that, the carbon price, how that sort of benefits Calix in terms of the economic model.
So in terms of the license or royalty fee we've struck, it is a percentage of, say, the value of the CO2 that the technology separates. In Heirloom, for example, we've got a $3 per tonne floor, and as the value of CO2 goes up, if there's penalties or incentives around that CO2, then there's room for that to move up. Okay. Currently, it's set at around $3 as the floor, which is about 3% of the $85 incentive, which is available in the US for CO2 capture. And so that's where that sort of license fee was struck. In terms of the overall economics, say, for the counterparty, a cement producer, for example, at the moment in Europe, they're having to go on market and start to buy CO2 permits. So some time ago, they were issued a certain amount of free permits related to their historic production.
Which were an asset on their balance sheet.
And that was a big asset on their balance sheet. And a lot of them sold it, by the way. A lot of them sold all those free permits and crashed the CO2 price. And so it was interesting that the EU then turned around and said, oh, by the way, those free issued permits, next year you're getting 2.2% less. And the year after that, 2.2% less. And by the way, it's going to keep coming down. And so suddenly all of the cement companies and major CO2 emitters in Europe are facing
Woken up.
a smaller and smaller ceiling on their emissions because their free issued permits are coming down. So to maintain, if they're going to maintain their CO2 intensity, they've got to shut plants down, or they're going to go on market to buy the CO2 permits. There's a freely traded market in the EU on that, and the price of that CO2 is now of the order of 90 to 100 euro per tonne.
It was like under €10 when they were selling.
When we listed Calix, I remember the CO2 price was hovering between 3 and 5 euros per tonne.
Should have invested in carbon credits as opposed to Calix.
Yeah,
30 times.
Well, yeah. So it was only as short as 3 years ago that we saw companies start to commit to net zero CO2. Countries start to commit to net zero CO2, and this is by 2050. But those commitments were not in place more than 3 years ago, and so suddenly. As these companies realised, oh shit, we better go cover our liabilities, because these represent hundreds of millions of liabilities to cement companies just in Europe. They better go cover those. So they went out and they actually had to start buying the CO2. So suddenly there's a demand for CO2 permits, and the price goes up. And so that's how that mechanism operates. And so you can see the royalty we make, which is a percentage of that, is just a small part of the overall sort of cost of mitigation versus cost of going to buy a permit in a cement facility. And there's other subsidies that can help bring that down to help a cement plant transition. But ultimately, the EU will wipe out free permits altogether. So every tonne of CO2 you emit as a cement plant in Europe, you've got to go and either mitigate it or buy a permit. What's that going to do to a price of a permit by 2030? It's and so
2030 is not far away.
It's not far away. And so with the EU introducing the cross-border adjustment mechanism, which is like a tariff for CO2 for any goods coming into Europe, then as that becomes fully operational, they will eliminate free issued permits to the local industry. So it's going to be.
It's a decent stick coming.
It's a decent stick coming.
And just in terms of from a Calix economic sort of revenue perspective, and again, it should be super high margin, right? Because it's a capital light model, that's a royalty fee. How does that sort of look across, even just a subset of the market in terms of cement and lime production? Call it a baseline of €2 or €3 per tonne, or whatever you want to pick. Just sort of conceptualise that about how big the opportunity is.
Yeah. So if I have a look at effectively just the process emissions from the cement and lime industries, what I mean by that is the stuff coming out of the rock. Just the stuff coming out of the rock. Today, 1.4 billion tonnes a year. And that's projected to increase as obviously the world urbanises and more cement and concrete is used. So 1.4 billion tonnes a year. So as a total addressable market, if we're $3 a tonne royalty minimum, then obviously you can multiply one by the other to have the total addressable market available for our technology just in cement and lime. That excludes direct air capture, which is predicted to be almost just as big a market. So it's a multi-billion sort of opportunity at very low resource and capital requirement, which again is why we really like the licence and royalty model.
And so just in terms of challenges on the business, how do you deal with, when you're dealing with a top three global cement player, the ASX wants to know what are the targets and what are you sort of aiming to do, and if you don't give them that, then they won't buy the stock, and if you do give them that, you run the risk of a potential counterparty sort of holding over your head that you're going to deliver this by June 30, and we're going to pull it back and we're not going to pay you as much. How have you sort of seen that, and how much of a challenge is that? Yeah,
look, it's a big challenge because you put in what you think are your reasonable goals for the year. Which have had an extremely good track record of hitting, right? And look, we have, but it's funny that a lot of those goals are hit, maybe a month or two after year end, especially with things like licence agreements. There's no doubt if you're putting in the public domain that you're expecting X number of licence agreements to be done by a certain date. Of course they do. Of course they do. And anyone who will use any of that in commercial negotiation. And so, we've been very firm and clear that we will not do a deal at any price, just because we've given a bit of guidance around a number or a date. We will only do the best deal for our shareholders as and when those deals get done, and so that might mean pushing stuff back, short-term pushing stuff back,
and short-term pain on the share price.
Exactly.
Long-term gain.
Exactly. No, and look, I think it was your term. The sugar hit. I'm not interested in the sugar hit. No, we're here for the longer-term value, and you can see the size and scale of these markets. You can see where a cent or two might make a difference in terms of the ultimate rate you might strike. And so, there's no way that we're going to allow ourselves to be pushed around too much and sell something for under the value that we need it to be in the best longer-term interest of the shareholders. So we're adopting an approach where we're not going to put a number or a specific license agreement through.
And I think particularly now that you've actually validated and demonstrated that you do have global players in the background. And just in terms of, so Lilac, Lime and Cement, it's had significant funding. It's been in the pipe for a long, long time. Carbon Direct, Boston Group, I think they are.
Yep.
A US group.
The US, New York.
What was that, 2021?
21.
21. Invested at sort of around enterprise value of roughly 500 Aussie.
Yep.
Which market cap isn't too far off that today. Obviously, it's the market's been pretty shitty over the last 12 months, and ESG stocks, with inflation rates and all those sort of things, have been hit. Some more than others, but how do you sort of look at that now? First of all, what was the sort of process back then? We didn't have a Heidelberg, perpetual license deal. We didn't have, DAC. How does that sort of process look? When you review it now. I'm assuming at some stage you'll look to run another process. To continue to fund and go harder because the opportunity is so immense.
Exactly. And look, at the time we started that process, I think the market cap of Calix was maybe 100 or 120 mil. And we felt that the lime and cement opportunity in and of itself was worth far more than that. And so to raise capital at head company level to continue to pursue that opportunity was going to be very inefficient. And, our feel came from having a look at what was happening in the private markets around investment into cement and lime decarbonisation technologies. So you were having rounds in the private markets that were many multiples of the value of our head company. And so that's why we went, as we did, into the private market to look at a subsidiary, to license the tech into a subsidiary, have the subsidiary start to be funded and ultimately spun out, I guess. And the other thing is we often get questioned about how can we concentrate on so many things. We've got a lot of opportunities. How can we concentrate on them? Well,
it's a separate company.
In now, that my association with that company is as chair of that company, and so I've got oversight. But that company has built 60 people in the last 18 months, and it has its own CEO. It's got its own CEO. It's got its own capability, and not just sort of corporate capability. We've got the best people from all of the engineering houses, ThyssenKrupp, FL Schmidt. We've got some of the best people from the industry itself. In terms of ex-cement and lime engineers and technologists, because they've been 20 or 30 years working for some of these companies, waiting for them to decarbonise, and nothing. And now they can drive it. So that company has super capability, and so that was part of the plan. So all we needed to do that was a small amount of capital to start to build that capability, and so. The actual strategy achieved two things. We were able to get impact funds to have a look at this entity because a lot of them can't look at public listed companies because they've got some very ultra high net worth people behind them, but they don't want that sort of public exposure. And it also that ultimately gave, as we said before, look through value. So they came in for 7% of the company for €15 million. Calix head company will always get 30% of the revenues of this company, regardless of our equity. So if you do the maths on all of that, it sort of came out at about 300 million euro enterprise value, which, as you've said, probably about half a billion Aussie. And so with that 15 million euro, of which there's still quite some left, by the way, because to build capability and all the grants that we've got and those sorts of things, it doesn't take a whole lot of capital, because we're still saying capital light, as we said before. So 60 people in there now, all of huge calibre, a full corporate structure, just with some oversight from Calix. And so in terms of focus, that company is off and on its way. It's off and motoring. And so that was the strategy. And funny enough, as we completed that deal, it made it easy for the market in Australia to have that look-through value on that entity. And lo and behold, people went, "Oh, okay, that's how experts are valuing this company." So
in the space,
impact funds don't invest lightly. They employed independent experts and have a lot of in-house expertise. So they did about 3 to 4 months due diligence on the tech before they invested, and so that in and of itself is a good yardstick to understand how the investment community sees the value of the tech, certainly in cement and lime.
Yeah.
And so, as you sort of were hinting at it, in terms of other opportunities to do that, basically the head company value is pretty much the cement and lime piece. Yet,
in terms of underpinned by,
and yet we've got a whole iron and steel piece which is emerging, which is very exciting.
And a bunch of other different things.
Exactly right.
So, and I think that's one of the sort of not items of conjecture, but struggles of the market around valuing. It's not on a multiple, and if it is on a multiple, it's ridiculously expensive and whatnot. And that's not the way that we want the market to look at it. How do you sort of, and again, you've done a hell of a lot since that first round with Carbon Direct. How do you sort of look at from other different peers in the space, particularly around, I think realistically the two companies that we look to receive investment are Lilac subsidiary and potentially Zesty.
Yeah.
So how do you sort of look at that in terms of the different rounds that have happened there, their advancement, their technology readiness level and whatnot? How do you sort of pin them, and what's the sort of best benchmarks to look at that to get, if Lilac was 500 Aussie, 2 years ago, it could be a billion or whatever it is.
Yeah.
And Zesty, there's this guy who's raised 50 at 200 and we're more advanced. How does that sort of look?
Yeah. So the closest benchmark we have in the cement and lime space is a company called Svante, Svante. Svante is using what's called a metal organic framework, a MOF for short, to capture the CO2 that's coming off a cement plant. And they have these MOFs, and they capture the CO2, and then they use steam to drive the CO2 back off the MOFs in a concentrated form, and then they condense the water and have a pretty pure CO2 stream. So it's a really interesting technology, obviously, but all of the steam they need takes energy, and that's expensive. So our target is to be minimal energy. Now we feel the Svante tech is obviously a higher energy process route, but so be it. Now Svante, the biggest plant they've ever built on a cement plant is 2,000 tonne per annum capacity. So for a start, the one we've built, which is pilot scale, is still 10 times bigger than that. Okay, so 10 times bigger. And Svante, we're looking at about a TO. They've built a 10,000 tonne per annum plant on a power facility, so they have built something of similar scale, not quite as big. And so I'd use them as a bit of a benchmark. It may be slightly behind us in terms of the cement application, but that's a reasonable benchmark. And so in late 22, they completed just north of a $300 million raise that gave them a post-money valuation of greater than $1 billion. US. Yeah. And so we'd see them as similar in terms of the tech development process. And the other thing is commercially, I haven't seen any agreement signed by them with an end user yet, with the industry. And so again, we're not privy, because they're a private company, to what may be in place, but there's no public information there that suggests they've validated their business model, their commercial model.
And again, not trying to pot Svante or anything like that, but particularly around industry and these global cement players, they want to be out there talking about these solutions, A, to their shareholders, and B, to the industry and government. So you'd think that if there was something out there, the cement players or lime players would want to talk about it. You don't have to comment on that, but that's my sort of thought process.
Yeah, no, look, all I can comment on is what's in the public domain, and as you say, we're not trying to pot Svante. There'll be areas where Svante could be quite compelling, where energy is very cheap, like US gas is dirt cheap and electricity is dirt cheap. Look, and there might be some collaboration we could do with Svante for fuel side capture where it's combined with Lilac. So I'm not trying to use this as a so Svante's but when
it's just interesting in terms of the benchmark.
Interesting in terms of the benchmark, in terms of value. I mean, Svante have raised over $500 million to get to where they are today. In terms of how much we've put into the Lilac technology, it's less than a fifth of that. And so we've been very successful in being capital light, using grant funds and being very judicious with the way we spend the capital, yet still have accelerated through the tech readiness stages pretty much similarly. So it's an interesting benchmark to use. And so, if we were to market today what the Lilac technology was worth, it's a very interesting comparison to make.
And just on Zesty, is there sort of thought process there of sort of a number of years behind Lilac? Lilac took a long time. You don't want Zesty to take that long,
no.
So harder and faster and get money in to accelerate that as well?
Yeah, harder and faster with Zesty. So just to give you an idea, we first filed the patent late 2014, maybe early 2015 for cement and lime. Obviously, the core process is patented, the particular application we also put a patent around, so there's sort of two layers around each application. So by the time we build our first commercial module, which is the Lilac 2 module, that will be 10 years from patent application to first commercial module build. And so I've set sort of the company the challenge to halve that. Now, the patent went in for iron and steel about late 2021.
Yeah, it was like around Christmas time.
Yeah, so just on Christmas time. So that gives us until 2026 to get our first commercial demonstrator built for cement and lime, for iron and steel, sorry. And so what does that mean? 30,000 tonne per annum, single tube, electrically powered, hydrogen powered, built by sometime in 2026 is what I want to do. Now, how do I do that? That will take some capital. If I have to wait for grant funding, part of the time it took with Lilac in Europe, apply for a grant, it takes 12 months and then 6 months decision, and then and you're in a consortium, so decisions have to get made amongst 13 different parties. And of course, to go faster, you need to be in control of your own destiny a little more there. That's not to say I'm not going to look at grant funding. I'm just going to have it dictate my timeline. And so what does that mean? That means that to progress the iron and steel opportunity, we want to have a look at some capital to build that demonstration unit. And with iron and steel probably hardly being valued in the head company at the moment, again, that would say to me, well, why don't we look at private capital and look at the same way that we did Lilac in the iron and steel opportunity. And what gives me a lot of confidence there, I guess, is, again, if you have a look at benchmark deals being done in the private sector from impact funds, you can see Series A, Bs and Cs that are along a trajectory for some of these technologies and up rounds that are placing considerable value on these. Now, I'll have a look, pick a couple. A company called Boston Metals. Their most recent round in 2023, supposedly when the capital markets are all crap, they managed to raise $230 million or so US bucks. And typically the Series C type rounds are at a 20% to 25%, but even if we say a 30% dilution, that places this company at nearly $750 million US post-money valuation, and they're not even out of the lab. You know, they're not nearly at the scale that we already are with Zesty. We're testing in a unit that's capable of up to 2,000 tonne per annum throughput, and they're probably still a small fraction of that in
and
the
you're
lab.
testing with all the leading players in Australia, which is
Correct.
Mostly all the leading players in the world, right?
Indeed. So the leading iron ore players in Australia. We're through the Heavy Industry Low Emissions Transition CRC, of which most are members. We've got a campaign happening now on all the different iron ores in Australia. Obviously, hydrogen direct reduction into a green iron in our little plant at Bacchus Marsh in Victoria. And so we look at the market, and there's Boston Metals that I mentioned. There's Electra, a company called H2 Green Steel, raised nearly $5 billion in debt and equity to go do something, to go do a green steel project in Sweden. And so even more than cement and lime, we're seeing valuations at earlier tech readiness level, companies barely out of the lab being quite substantial.
There's such a need for it, and it's so early, right?
And this is it. I think with cement and lime, I've always said, we're probably one of 6, maybe 7 different technologies that will ever decarbonise cement and lime. So it's a very limited number of players in that space. So you automatically get quite a bit of attention. Well, iron and steel, if anything, could be even smaller. There are very few different concepts that will ever resolve the CO2 issue for iron and steel. And to be one of those puts you in a very concentrated space. And so, again, being iron and steel being sort of 8% of global CO2, 7 to 8, alongside cement and lime as one of the biggest industrial emitters, there's a lot of capital that's looking to be deployed to resolve the CO2 issue there. So it's a happy space to be in, that's what gives me the confidence to have a look at this mechanism.